Hey traders, Raghee here, and in this recap video we're going to cover crude oil. Now crude oil had the API number release that came out after the bell, 30 minutes after the bell today, 4:30 Eastern, and there's a kind of surprise buildup in crude which has kept the intraday downtrend intact. Now I'm going to talk about the API and EIA numbers, but what I really want to talk about is the zone on the daily that we've been playing based upon the range that's sitting up here between the $50 major psychological level and the 200 period simple moving average. So two very well watched levels for two different reasons, but two very well watched levels. And inside that about 0.35, 0.40 area is where exhaustion could be seen. So it's a wide range, and we don't know how much higher than 50 even we could go. So I like this example because it actually didn't go well the first time. So here we are nearing 50, and this is a little aggressive because if I'm looking for the market to actually get to the 50 level, this would not have worked. But if you want to be a little aggressive, you take this level. Okay? Well, this is 49.45. That's stepping out in front by about 45 to 50 ticks. Now that might be okay for some of you, but that might be too much extra risk for others. So you make a decision based on that. For the rest of you, once we hit 50, now we're thinking, okay, where can we get the reversal? And whether or not we take it on the 30-minute has a lot to do with the quality of the uptrend. Now, I think the quality of the uptrend was probably a little bit better on the 60, but probably not much more. Probably a little bit better. We never plotted any red grab candles like we did on the 30. So once that failed, you probably would step out to a longer term time frame. So keep that in mind. If one time frame fails, step out to the longer term time frame. It's just going to automatically give you a more conservative entry. And here it is again, 50 triggered, and we basically take the breakdown through 49.80, which would be a 49.75 short. And then finally we got our follow through. And then this follow through here, well, that's the API number. Okay, that's the API. So we're getting some good follow through after a quick bounce. And that's what's happening on crude. So here the moral of the story, the lesson is, if the first trade doesn't work, the reason we go intraday is that they're tighter stops and they're more minimal price movement range expectations. Now what's the price movement range expectation for crude? Let's go to the energies. Let's go to crude oil. And the hourly price movement range, take a look, it's about 40 to 60 cents. So we're keeping that in mind, 40 to 60 cents, not only profit, but 40 to 60 cents possibly as far as how much risk you might have to tolerate in order to keep the trade and allow it to move. It's very normal, very typical price movement range. So I'm liking this exhaustion here. And the reason we look for the wave reversals is in the vicinity of the area we expect there to be exhaustion. I took both. One was about 50 cents. That was fine with me, this 50-cent extra that I paid up. And let me show you why it's important to remember where sometimes you might want to be a little bit more aggressive. Cocoa is another example. Now cocoa was easier. Our level for a cocoa short was 20.95. The market topped out at 20.90. You know, basically gypped us of a very nice short by about 5 ticks. So what do? Well, those of you that are realizing, hey, we're about 10 ticks from our entry, you start taking a look at the 30 or the 15 or the 60-minute time frame, and you see, okay, my limit order that's waiting to short at 20.95 is not going to get hit. And here comes the wave reversal. And there was your short sell. So this is where an example of the market falling just short of your daily fade, well, you were able to capitalize on that by playing the momentum of the wave reversal breakdown. Is a 20.45, 20.50 short, even 20.75 as good as a 20.95 entry? No. But if the market does not touch your limit order and your next opportunity could be breaking support to the downside with momentum, here's where that intraday trade lends itself very well to daily setups, either as confirmation or as a guidance trade, as I like to call them, or as a way to basically modify your strategy a little bit. It's still the short side, but you modify your strategy a little bit in order to capitalize on the move lower when the market didn't move fully to a level that you were expecting it to, and it gypped you of that longer term entry. So two really different examples in two very different market sectors. Cocoa and crude oil, same setup, very similar dailies in chop, and then very similar intraday time frames rolling over from an intraday trend. Think about this setup next time you're looking at choppy markets at range extremes, and see if it might not be a great way to either trigger or manage an open trade.